Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And we are Saturday, and we are talking about money. So there's a new Bank of America survey out talking about the perception among money managers. They take a survey every month, and what they found is that they have become the most negative they've been since 2009. Negative, more negative than they've been since 2009. Is it really that bad? You know, what they said is they're really concerned about counterparty risk. Almost half were concerned about counterparty risk. What does that mean? That means when two people sign a contract, one side default. So they're concerned that there's going to be defaults in contracts. Half of the survey, nearly half of the people surveyed, said they were really concerned about that. As fund manager. They also said about a third said that there's a significant problem with systemic credit risk. We went through Silicon Valley Bank. We know that came down. Now there's concern, that there might be another Credit Suisse or another big bank that comes down. And does it spread? A third are concerned about that. A quarter are concerned about ongoing inflation, that inflation is going to continue and continue and continue and continue and continue. On that, they may be right. They were also concerned, about 1 in 6 are concerned, that the central banks are becoming hawkish and not going to lower rates. A sixth were concerned about geopolitical risk. It's not just the war in the Ukraine they're concerned about. It could be a tsunami, it could be a volcano, it could be anything. It could be a meteor. Who knows? Could be the overthrow of a government. Who knows? And 1 out of 10 were concerned about a deep recession. Interesting that only 1 in 10 were concerned about a deep recession. We've heard a lot of people talk about a deep recession. All of those perceptions are really similar to what you see at the bottom of a market. And remember, these are the most negative comments we've seen since 2009. These are the fund managers. These are the professional money managers. And what happened in 2009?
The market bottomed out, Mike.
The market bottomed out in 2009.
And then what happened from there?
And then we got into a market where it went from 6,600 to 32,000. They had these same kind of concerns back then. Not the inflation concern, but they certainly had systemic credit risk. They had systemic counterparty risk, geopolitical risk. They had a lot of concerns then, and the market just kept going up. They say it climbs a wall of worry, but when you read about what they thought, the picture I got is the hypochondriac going to his doctor with all these health problems. I mean, none of which really exist, but they're just worried.
Right. And Mike, but remember before 2009, 2008, and 2007, and they were euphoric. No, there was no problems in the economy. Even had Alan Greenspan saying, no, there's no risk to the housing market. The housing market's fine.
Yeah.
And then kaput, right?
Yep.
And then 2009, as you said, the most pessimistic, negative, and then the market takes off.
So are we at that point? Are we really at that point? So there was an article out of The Economist, and it left a lot of information, and I think it paints a really good picture of what we're looking. Now, our focus at Adams Financial Concepts is long-term. So what happens in the next 3 months or year or 2 years is less of a concern than what happens over the next 5 to 10 years.
I just read this morning from Goldman Sachs, and they had the same sort of, not pessimism, but concern. But they also said, we believe in staying invested.
So I thought some of the information from The Economist was key when they talked about what's going on. The United States is not the largest economy in terms of purchasing power anymore. We're about 16% of the world purchasing power. China's 18%. But when you look at GDP, the U.S. GDP is 25% of world GDP. Now, if you look at it over the long term, going back to the 1950s or 60s when it was 50%, that's a big change. But in 1990, we were 25% of the world GDP. And China is just 18%, even though it's grown. GDP numbers are very, very different. Ours has maintained a relatively stable amount of world GDP. And if you look at the S&P 500 companies, half of their revenues come from overseas. And it's not just about bringing things back. It's not just bringing manufacturing back. You have companies like Seattle Starbucks. They can't move all those coffee shops back to the U.S. They generate a lot of their revenues overseas.
Yeah, we just saw Apple's opening a big plant in India.
Yep. So that's happening worldwide. And so if the U.S. is at the same level and China has been increasing from less than 1% to 18%, who are we taking market share from? GDP market share, if we can call it GDP market share. If you look at the G7 nations, which are the UK, France, Germany, Italy, Canada, and Japan, and the U.S., our percent of that G7 GDP is 58%. In 1990, it was 40%. So our GDP is growing faster than the G7 nations.
And I'll say this about China, to put this in perspective, Mike. China's 18%. They started from, very humble beginnings.
Yeah.
And with all the money they spent on infrastructure growth and building their country, which they've done a great job of, that's where their growth is coming from. You can't sustain that forever. We can't keep giving each other haircuts to make the economy grow. And you and I don't need, can't really get any more haircuts anyway, so especially me. But that being said, they haven't transitioned to a consumer-based economy. Can they continue that and make that transition is the big question.
It truly is the big question.
And so their 18%, if they fail at making that transition, are they willing to give their people that much freedom? I don't think they are, from everything I read and everything you and I have talked about.
No, I think that China is going to keep the squeeze on, and they're going to continue to do and progress very much in building manufacturing plants, in building roads, in building infrastructure, but you can only build so many roads.
Right, and as we see with Apple building a plant in India, and I mean, we mentioned before talking about China and India and what's going to happen here. I think as people start to de-risk from having all their products built in China, which is we see happening from the United States perspective. Maybe some of the European countries, maybe France is still trying to sell its cognac and wine to China. But as we see, us pulling back from making manufacturing over there, moving it to other nations, what's going to fill that gap?
Yeah. And there's no question that the per capita income in China has been rising significantly, and the number of people that are moving out of poverty, out of living on $2.90 a day, that's significant.
It is.
And the Chinese people are moving from subsistence, where they grow their own food, make their own clothes, and do the same things you do when you make $2.90 a day. They're moving into some consumption.
They are, but we mentioned on a previous show about this thing called the middle income trap.
Yep.
Where countries who start from subsistence and then get to, build a manufacturing base and then build some sort of a middle class and then try to get to that next level, if they don't make the changes they need to make, they get stuck in that level, and their countries don't really progress.
And that's where China is.
Right. So the big question is, will they move from that middle income trap and consumer-based economy where people can actually progress past that income?
And they have a big issue coming up, because when they started the one-child policy, the average life expectancy was 64.
Yeah.
Today it's much higher.
They have a terrible demographic problem.
Yeah.
Worse than the U.S.
Oh, worse
than
Japan.
Worse than Japan. Worse than Asia. Worse than Europe.
Because they're soon going to reach one worker for every retiree. And that puts tremendous pressure on what they have to do in terms of taxes to pay the pensions.
And they thought that when they got rid of in 2015, the one-child policy, they tried to spur people to, have babies. They thought, this will work. The people that moved to the cities that were, had their own apartments, their own cars, and had a little bit of money in their pocket were like, the heck with that. I want to keep doing what I'm doing. I don't want that dragging me down, And they're not doing it. They can't convince them to do that.
And if you look, coming back to the U.S., we talked about China having that problem, because when you have a one-to-one relationship, that means half of what the economy needs are money to pay pensions. So what about per capita income? We're going to come back and talk about that after this commercial break. Talk about America, on what's going on in America compared to the rest of the world, because I think the picture looks really good. I think it looks very good for America in the long term, even though there's a lot of people that are spelling out terrible words. We see some really positive things happening. So don't go away. If you miss any of this program, you can find it on YouTube, About Money. Don't go away. Check us out.
about money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we've been looking at this whole thing of all the people talking about negative things. We think that there's a lot of positive when you look at what's going on in the United States. If you look at per capita income and just the developed nations, the G7, UK, France, Germany, Canada, Italy, Japan, and the United States, our per capita income has grown 30% since 1990 versus 24% in those other nations. And if you compare the United States to Japan, we're 54% higher in income than Japan. Japan has only increased 17% in those years. Although that appears to be turning around, it still means a significant difference. And if you look at where we are in terms of social spending, we spend 18% of our GDP on social spending. That's up from 14% in 1990. And a lot of that is due to the Affordable Care Act. But it's not an insignificant part of what we spend. We talked about China. We're talking about China and the issue that they face with a 1-to-1 ratio, one worker for every retiree. And they're going to probably deal with it by raising the retirement age. And that is something that goes over so very well. We see that in France, where they want to raise the retirement age. I remember being in France. I worked in France for a year and a half. And about that time, there was a concern that there weren't enough jobs. There were too many people. And so they reduced the retirement age from 64 to 60. Now they want to reverse it and go from 60 to 64. People were happy in those days to take a special supplement to retire prior to age 64. If you were 61 or 62, the government paid you a big chunk of money to retire early. Today, they want to stop paying you retirement until you get to 64. And there's no doubt the United States is probably going to have to raise the retirement age to 70 or 75. We're getting older, and we have issues with the Social Security system. But you do that a long time before it happens. Not like in France, where they want to make it effective almost immediately. And I'm not even sure about that. I haven't read that much about that. But that's where we are. The United States has the ability to make that social spending and make it effective. And even with all the concern about the debt limit, that is a concern because it does come up in July.
It will get. I think it'll get passed.
I think so too.
They're just politicking. Right? They're posturing right.
That's posturing.
But the only thing that does concern me is looking at the rise in credit card debt, consumer credit card. I think.
And yet, when you think about what we've gone through in 2020, we had the stimulus checks go out. We've got incomes increasing very rapidly.
We do. Mm-hmm.
And so a lot of the credit card debt is due to that.
Yeah, but I think that and I also think that some of the numbers that people are looking at really not real in a sense. If you're looking at manufacturing numbers or retail sales, because people had bought so much during the pandemic that they're not doing that, and they're spending it on other things such as travel, those type of services.
Yeah, so my wife and I just made a decision to make a big trip. And then talking to the travel agent, she said it's like they're just overflowing with people. A lot of people that have travel things that are on their bucket list, they're doing them.
Mm-hmm, mm-hmm.
And when you think of us, I think a lot changed in 2020 with COVID. Being locked in, being sheltered in, made a lot of people think about where they are.
Yeah, all the people that retired during that time said the heck with it.
Yeah.
And all the people that quit their job and said, oh, the heck with it, I'll do this, wait, find something else.
And I think it's also a time when a lot of people began to think about how short life is.
Yeah, right. No, right. I think the huge psychological effect. And I think a lot of this is we have more information in front of us than we've ever had.
Mm-hmm.
And so people can get online and look and say, if they don't know much about economic and finance, say, well, what is this recession thing they're talking about? How long will, it's only going to last a little bit of time, maybe a year, maybe 18 months, maybe they'll average last 18 months?
Yeah.
Oh, I'll be fine. I'm going to go do what I want to do anyways, because in 18 months, things are going to turn around. And with the job market as tight as it is, why wouldn't you think that? Even if you're having a little bit of tough time, why wouldn't you think that, oh, wait a second, I can go out and try to find something else, and I'm just going to keep doing what I'm doing.
And I'm going to go find something else at a higher wage.
Yeah.
I mean, people are jacking up prices to hire people. And thinking about this whole thing, we've seen a change in what's going on.
Yeah, there was a story the other day, Mike, speaking about that unemployment. Go back to talking about Swedish Hospital. We talked about the million nurses that are 1 million.
Yeah.
They had a story about Swedish Hospital, and they're trying to hire and trying to fill their gap. They're raising wages 20%.
20%.
20%. They said, well, we're giving 20% raises kind of across the board, and new hirees. They're giving, I don't know about I didn't hear anything about signing bonuses, but that's what's going on.
Well, before COVID, one of my doctors is Swedish, and he was already talking about they were having trouble keeping nurses because it was better, or for the nurse, it was less expensive to go to General Hospital in Renton because the commute time was less, the cost was less. You could afford to take a smaller salary.
Yeah, and there was something else about traveling nurses who, kind of can do 3-month stints and bounce all over the world, really. They were getting paid more than the nurses that were at the hospital.
Yeah.
So the other nurses were like, well, wait a second, I'm here all the time. Why should I make less money? And so they decided to make some corrections to, that doesn't make a lot of sense.
So wages are up 20%. And,
Yeah.
and that's going to be a trend that continues. And we see it in office workers, where 40% of the people who said if they're ordered back to the office, they will look for a different job. 5% said that if they're ordered back to the office, they'll quit. Mm-hmm. And we've seen that happen. And not only do they quit, but they find another job almost immediately.
Yeah.
So what we're seeing is a transformation take place in the demographics, the way people live.
And as we look at, just in Seattle, they keep talking about, listen to stories about trying to revitalize downtown, the money and the stuff that have to be spent, the brain power that's going to have to be thought out to revitalize these downtowns, which they want to do. They're committed to doing. That's another opportunity where you see a lot of growth and people moving back to these areas, building these areas.
Yeah, and yet when you look at the downtown Seattle, in our building, it's 94% leased up and 47% empty.
Well, it's not going to be that way anymore, Mike. You better start learning how to play pickleball. According to this is a true story, they said they were going to convert some of the streets to pickleball courts. And then they're working on another thing where they said they want people to go buy a drink at a restaurant, have a wine or a beer, and then be able to go walk to the museums and stuff. So be able to go to your restaurant, leave with your drinks, go play some pickleball, and go to the museum.
There's going to be changes that take place.
They have to, right?
I mean,
to revitalize. But that's an opportunity for revitalization and growth.
And those are all investment opportunities. As we move the supply chain back, that's investment coming back. That means it's not going downhill. It's going uphill. It's not a market that's sinking because people are not spending money. They're spending money. As you raise the question, credit card debt is increasing. That's not because people are hunkering down. It's because people want to go to the Galapagos Islands or want to go see Petra.
They do, but part of that was due to some middle income and lower income people having to use the credit cards, keep buying expenses going forward.
Yeah.
So
So
there's a couple ways to look at that. You can look at that as something that's, if they keep on doing it, then it could be a problem. But if it's only for a short amount of time and they go get another job and make more money, then it shouldn't be that much of an issue.
And when I go, and maybe it's just, my peculiarity. My wife doesn't let me go shopping very often because she gives me a list of things to buy, and I come home with a lot of things that are not on the list, and a lot of things that were on the list don't make it home. But I was looking, during COVID, I also did some of the shopping, because my wife had a surgery. And when I looked at the eggs in the egg cart, there were a few that were pasture-grown eggs, maybe 8 or 10 cartons, and most of the eggs were the regular...
Sweatshop eggs?
Sweatshop eggs. Good way. I was in there last weekend, and there's more pasture-grown eggs than there were sweatshop eggs.
Yeah.
And the difference in price, it's almost twice.
Twice as much.
Twice as much. So it's not a question of people not having the money to buy. They're beginning to focus on quality products and health products. I mean, for me, it was a real surprise to look at the egg.
Price of a high quality, locally.
High quality versus lower quality.
And they taste better, too, if you try them. It tastes
Oh,
a lot
yeah.
better.
They're much better.
Oh, much.
My wife uses the lower priced eggs in cooking, but we use the other. And it's because they do taste better. And yet I'm seeing most people have to be buying those. A lot of people have to be buying those. That's a real change from what was happening in 2019 and before.
No, and just look at some of the numbers, like they talk about the housing prices and home builders stocks were up. I think at D.H. Horton's one company was up 7%.
Yeah.
In the States, they said, no, we haven't seen any. They keep on building and building homes. And the demand for homes, we're still short supply of homes.
Yep. We're coming to a commercial break. Don't go away, because we're going to wrap all this up on what it means for you, the investor. What is the message you're receiving? Is it negative or positive? Don't go away. We'll be right back.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So we started by talking about the negative Bank of America survey, with fund managers being more bearish than they've been since 2009. That was the bottom. 2009 was the bottom of the market. If you look at where the United States is, if you would have invested $1,000 in the S&P 500 in 1990, it would be worth $23,000. If you would have invested that same in most developing countries, it'd be $5,100. There's a reason for that, and that's the power of the United States. We've been talking around the whole thing, but as people talk about all the negative things that are going on, there may be negative things that happen on the short term, but if you're in this for the long term, and if you're an investor, you should be for the long term. Unless you have immediate need for cash, you should be looking at this for a long term building wealth, not for the short term. And if you're looking at the long term, you're looking at the health of the United States. And we've been talking about it. The health of the United States looks pretty doggone good, very doggone good.
Especially compared to other countries.
Especially compared to other countries. So it's something to think about, listen to, but the people that are so negative as they were in 2009, they were wrong in 2009. You know, Andrew Roberts, I love these stories. Andrew Roberts in June of 2010 said, by the end of the year, you're going to have to think the unthinkable. The market is going to crash so bad by the end of the year. 2010 didn't happen. Mark Faber, Dr. Doom, said in 2009, the Fed is pumping in money. We're going to have 100% hyperinflation. 100%, just like Zimbabwe. Money's going to be worthless. Oops, didn't happen. Then he came out later in that year and said, 2013, there'll be a 1987 crash. Seeing the market drop 30% in a day, maybe more. Didn't happen. But 2013 was a key year because Michael Lombardi, during that same time period, came out and said there's going to be a great crash, worse than the Great Depression. There's going to be blood in the streets. His comment, blood in the street. All of that. Did it happen? No. When we're looking at this, you're looking at a stock market curve that starts in the bottom left-hand corner of the graph and goes to the upper right-hand corner. And yeah, there are times when we see things plunge down, but we've recovered every time. And if we don't recover, there's bigger problems anyway. If the Dow goes to zero, we have a lot bigger problems than...
Yeah, all bets are off, I tell clients.
All bets are off. Yeah.
But, Mike, people keep pointing this thing called the yield curve, right? Inverted yield curve. You hear that thrown all over the place. Just Google it, and what's an inverted yield? When short-term rates are paying more than long-term. And so that's predicted, 9 out of the last 5 recessions or whatever, right?
It has.
Yeah. But the guy who found this correlation, his name is Campbell Bell. He wrote his dissertation on it, that every time they saw the inverted yield curve since 1950, 18 months later, precipitated a recession. But there was something I read saying that this time is different. That this yield curve is not a function of financial markets like what happened in 2009, everything collapsed. 2008, excuse me. That right now the Fed has manipulated this market by borrowing from money market funds, from banks and from consumers to keep that money from flowing into the economy or anywhere else to investments, and they're paying high interest on these. Money markets are paying 4.5% interest on this money, and so that is propping up short-term interest rates higher than long-term interest rates. But if they let that money go, that the actual numbers, the equilibrium would come back, that long-term rates would be higher.
So remember how we got to this point. In 2008, there was a lot of money poured into the economy. And when you're talking about borrowing, when he talks about borrowing, essentially what the Fed is doing is giving money to the banks, giving money to money market funds. You can term it as borrowing, or you can term it as printing money, or putting money into the economy. You can do all sorts of the terms. Same thing, because the Fed is pouring that money in to the banks and into the economy, and that's a stimulating effect. That's Keynesian economics.
Mm-hmm.
It's something that John Maynard Keynes came up with and said, when that happens, when you pump money into the economy, the government pumps money into the economy. When the government runs at a deficit, it's a stimulus to the economy. But what happens when you take the money back out? And that's what he's talking about right now.
But we've never been in this boat before where we had, I mean, the Fed's balance sheet in 2008 was $800 billion. Mm-hmm. It went from $800 billion to $4.5 trillion in 2015. From 2015 to the pandemic, $9 trillion.
Yep.
And then they started to deleverage that last year by $48 billion a month. And then last September, they ramped it up to $95 billion a month they were going to get rid of them off their balance sheet and try to get it back down to a reasonable amount.
Which means they're reducing their borrowings and they're pushing the Fed funds rate up. But as they put out money and as they put short-term money out, because that's what it is, they're taking money back from the banks. They're taking money back from the money market funds. They're reducing their balance sheet by doing that. They're essentially calling in the loans that they've made, and the loans in which, because they didn't start paying 4% interest. They started paying 0 interest.
Yeah, right.
But they have to pay Fed funds rate for that money they've put out. So,
well, according to this article, they're paying current rates of 4.8 to money market funds and 4.9 to the bank. So there's a 10 basis point spread basically that they're paying. But what he's saying is that if I understand him right, is that they're manipulating the money markets, using the money markets to manipulate the cost of money, driving the short-term rates up, and that's artificial from the past inverted yield curves where it's just been a function of the natural market and things supply and demand for money.
So what is it about the Fed's funds rate? The Fed sets the Fed funds rate. They say it's not a market-driven thing. It's strictly driven by Fed policy.
Right.
This is the amount of money that banks can borrow money from other banks for. And banks all the time borrow money back and forth. They always have. You balance up the books at the end of the day and you look at your deposits and your withdrawals and balance up and you borrow money from other banks or
Mm-hmm.
deposit money from other banks. And the Fed sets the actual interest rate. So when they have put money into the economy in 2020, they put it into banks because they wanted banks to be flush with cash, so banks would have to loan the money. That was the idea.
It didn't happen after 2008 though for a while.
Oh, it started.
It took a while. It took a while.
It took a while.
Yeah.
But the Fed knew that.
But they did it differently in 2020 when they started giving money directly to businesses, right? When the PPP loans was a different animal than 2008. 2008, they knew because the banks held that money for so long. It took so long for the consumers to start getting that money. So in 2020, they said, no, we'll do it differently so the consumers get the money quickly. Correct.
So that was the PPP
program. Loans. Yep.
But those were forgivable loans.
I know. Yeah.
Whereas when you give the money to the bank eventually has to pay that back. And the bank has to pay it back, not when they decide to pay it back, but when the Fed decides, we want you to pay us back. And I don't know that that's completely true. I don't know that much about it. But I do know that right now, the Fed is getting the money back that they put into the economy. And they're getting $95 billion. And it's easy to do for the Fed to do that with banks. A little more easy to do for money market funds.
So my question then is, if they take this roughly $6 billion from money market funds, is that reducing their balance sheet? Are they still deleveraging their $9.5 trillion? So their balance sheet should be somewhere down around $3 trillion if they've taken this money back out.
When they've taken it all out.
Yeah, so they've
got $6 billion to take back out.
So they've got six. So it says here they've taken $6 trillion out.
That was
out of this money market account.
Okay, so that's putting that money in. They borrowed that money.
So they're borrowing it back out.
They're paying it back out.
Yeah, they're borrowing it.
They're borrowing it back.
Right.
Okay.
So I wonder if that reduces their balance sheet of their $95 billion that they're.
It's part of reducing their balance sheet, and all that figures into the yield curve, and that's something that we've never seen before. Because the Fed never had this kind of a balance sheet.
Right. And that's what I think he's getting at with this being a different number. So this being a different indicator, that if you're looking at the yield curve, it's kind of skewed because of the Fed's balance sheet, and that we've never been this before. And so does that necessarily dictate that we're going to see a recession?
And it doesn't.
I think I kind of glean a little bit from this that there's a couple different ways to look at this, and that it's not a classic case of an inverted yield.
Yeah. We're going to come back and talk about this more. We're coming to commercial break. But the yield curve, so many people talk about the yield curve.
Well, it's all over the place. You can't open anything about the economy in a recession without seeing what the yield curve, and go study yield curves. I think people have done their whole dissertation on yield curves, haven't they?
And things that have never happened before happen all the time.
And I think this is one of them.
We'll be right back after this commercial break.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, we just got done talking about the yield curve. It's like it's complicated. It's not as simple as it seems.
No.
You really got to sit down and look at it and digest it to really understand it. The other indicator that I watch a lot is something called the VIX, the Volatility Index. And that's the fear gauge in the market. The higher it goes, the more fear in the market. Like during 2009, it was in the 80s. During COVID, it was in the 50s. Right now, it's hovering around 16. Its historical average since 1990, when it kind of started, is about 19. Some people say, okay, that means there's no fear in the market. Why are we talking about a recession if there's no fear in the market? The VIX should be at 30, 40, 50 if we're talking about recession. And one guy that I'm reading is by the name of Steve Sosnick for Interactive Broker was saying, well, this is the bad sign. He looks at it as, well, the VIX is ready to jump 20, 30, 40 points.
Yeah.
And I mean, I look at it, if there was that much fear and we're predicting recession in the next half of the year, that there would be a lot more volatility.
Andrew Roberts said in June of 2010, think the unthinkable, because by the end of the year, the market's going to completely crash. I mean, the VIX running at 13 or 15 or 19, whatever, and it bounces around. It's a long way from the fear levels. So either this time is different, and it could be, or the indication is that there isn't that much fear, or that people are not expressing their fear.
It could be, but you'd think that they'd be buying futures on the VIX for buying calls on the VIX for it to be higher. We'd see that call put ratio on that to be higher, that they would drive it up. But I don't see that happening. It's actually keeps dripping down.
I think, when you look at it, going back to the beginning of 2022 and people predicting that there was going to be a recession by the middle of the year, we were going to be deep in a recession. And you had a few people saying maybe it's going to be a soft landing, but it's going to happen in 2022. And then when it didn't materialize.
Well, we did have that 2 quarters of negative GDP, right? In like the second and third quarter. And then we saw the market bottom out in October and then take off from there.
Yeah, but in order for a recession to actually be called a recession, there's more than just the GDP numbers that figure into it. There's unemployment. There's consumer
Agreed. I'm just going off of like the yield curve, right, Mike? I mean, inverted yield curve means recession. So if we had 2 quarters of negative GDP, then we got the recession out of the way, right? We're done with it.
So we never had a recession. It doesn't appear that we're going to have a recession. And maybe we could be wrong, and maybe it's going to happen at the end of this year. Maybe it's going to happen in 2024 or 2025. But right now, there's so much positive going on in the market. And you have the green energy stuff that was passed. That's pumping money into the market or stimulating the market. You have the infrastructure bill that's pumping money into the market. You have the supply chain that's pumping money in. All those things are pumping money in. And we have 5 million more jobs, maybe 6 million more jobs than we have workers. And so people are seeing wages increase, especially at the bottom of the demographics.
Yeah.
All those things are non-recessionary. And so when people really look at it and begin to forecast and think about what's going to happen in the next 3 to 6 months, I don't think the worry is there.
I think anything could happen in the next 3 to 6 months. I mean, it's like we're watching a hockey team in their first playoff, their second season, they're in the playoffs, right? They just knocked off the last year's Stanley Cup winners in the first game.
Yeah.
Okay, anything can happen in one game, but over a 7 game, I'd put my money on last year's Stanley Cup winner. So in the next 3 to 6 months, we could see the things go down. We could see some blips of, drop of 10% or whatever, and things get volatile for a while. And I would expect that to happen. I would expect something's going to happen. Some sort of shock's going to happen, whatever it's political or anything like that, that's going to cause something like that, a ripple for a while, like we see with the banks. There could be more banks out there that have upside down balance sheet.
Or it could be counterparty risk. That's what people are. Half the fund managers are worried about that, because that's something that's almost invisible to the markets until it happens.
Right.
That's the hedge fund that suddenly goes down. What was the name of the hedge fund?
When was it?
Oh, he had borrowed more money than the value of the funds were worth. Not Axios, Archipelagos.
Oh, Archipelago, yeah.
I mean, he had more debt than he had assets.
Yeah.
In the fund. That's a counterparty that they can't pay off the bank.
Yeah. I read about another company like that this morning that might be in that same situation, some sort of VC fund. And that's business risk that's going to happen. I don't think the systematic risk that you mentioned in the first session, I don't think I see the systematic risk. I think the big banks and the big companies, and we see Apple with $140 billion in cash. We see Microsoft with $100 billion in cash. These companies are flush to spend money and making deals. The administration hasn't been kind to them, to this deal making. We see Seattle Genetics one might be bought by Pfizer, if the administration approves these deals. But there's a lot of this stuff going on, and I'm like,
yeah,
I just don't see that the dire straits that these guys see.
No, but I think there's the old saying, to keep clients, don't lose money. There's 3 things: don't lose money. Rule number 1. Rule number 2 is don't forget rule number 1. Rule number 3 is don't forget number 2.
Yeah, I mean, I was talking to a potential client this week, Mike, and she gets spooked out of, she was spooked out of the market.
Yeah.
And so someone came to her with selling her a safer, this is safer, this is safe, these commodity funds and these alternative investments are safe. And I'm like, there's risks to everything.
Yes.
Anybody tells you that this is safer than that, yeah, maybe so, but there's underlying risks to everything you do. And I think we've talked about it. You mention it all the time. I don't think the risk is being out of the market. I mean, the risk is being in the market. The risk is being out of the market, especially with inflation.
Yeah, because inflation is eating 5%.
Yeah, even the Goldman Sachs thing that I read this morning said, hey, the risk is being out of the market. We'll ride this through and we'll come out the other side.
Yeah. No, the risk is very definitely being out of the market at this point, even taking the fluctuations up and down. And if you look at where we are on our 5-year, 7-year, and 10-year composite of our clients, they're equally in the S&P 500. And we underperformed for a couple of years, but we're outperforming now. I mean, it's an up and down thing. And with inflation eating away at 5 to 6% of the purchasing power, that's a significant amount. It doesn't seem like that much. But the average inflation between 61 and 79 was 6.8%.
Yeah.
We're almost there.
And then in 2025, those Trump tax cuts are going to be sunset. So your tax rates are going to go back up. So between taxes and inflation, you better be able to stay ahead of the market.
Yeah. Anyway, we're positive on the United States. We're positive on where the market's going, and we're positive on where we think things need to be. The risk is not being in the market. The risk is being out of the market.
We'll go back to Warren Buffett's letter, Mike, that we read a couple weeks ago. I'm not going to bet against America.
That's the whole point. Anyway, have a very good weekend, a very good week. And if it's Saturday, we'll be back to talk about Monday. Money, not Monday.